Hi, my name is Michael Badnick. I'm sitting here with Logan Mohtashami, Senior Loan Officer at AMC Lending Group and writer for HousingWire. Today, we're going to talk about all things related to the current housing environment. Stick around, we'll be right back. All right, Logan, thank you so much for joining me today.
Pleasure to be here.
So, what were you seeing in the housing market prior to the outbreak?
You know, the BC economy, especially the BC housing market, BC means before coronavirus, was hot. You know, it was for the first time in this cycle, we saw a breakaway in demand. Purchase applications were double-digit growth right at cycle highs. New home sales, 2-month average was the best in the cycle. Housing starts were up 40% year over year. Mortgage rates were low, but the sales number was extremely strong. It was stronger than I thought would be the case for 2020. So purchase applications were actually positive all the way to March 18th. That's how strong the housing market was, that we saw year over year double-digit growth, and then the lockdowns came. And then once you got lockdown protocols come in, especially here in California, New York, the market just cooled off because it was actually working from the highest level in terms of demand for the spring. And now we're just seeing a kind of a comatose housing market where listings are coming off, sales are coming off, and that's pretty much what you see in the economic data as well.
So how quickly did the market turn?
11 days. 11 days
Wow.
was basically, I mean, even the U.S. economy, regional manufacturing was positive, ISM non-manufacturing was positive, retail sales were positive, jobless claims were positive on March 12th. So we're talking about 11 days. Once lockdown protocols are in, basically that's it. Because you can't have a listing. You can't have, people just started to question their current home buying. And then there was the mortgage market meltdown, which happened on March 9th as well, that week. So you've got two factors coming in at once.
So what happens to the houses that are already listed? Do they have to come off the market? Like, are people even allowed to sell homes right now?
Well, people are still buying and selling homes. It's just that the pace of where we were was too hot for it to even remotely come true. So you actually have people taking their homes off the market because from what I'm seeing, people are saying, why am I going to sell in this environment? I'm not going to get the price I wanted. And then they just say, I'm going to put the house back on the market, in a few months when lockdown protocols are taken off. But there are actually people buying and selling. I've had people just say to me, hey, listen, I got no competition right now. I could put, just a listing price and get the house I want, not worried about getting outbid. So there are transactions doing, but because we're talking about state by state, depending on when the lockdown protocols are, Florida and Georgia were the last two states to really go into lockdowns. Each state is going to have a little bit of different data, but the next existing home sales, which actually going to come tomorrow, is actually not going to show the full effect of the COVID recession. It's going to be the April data because it's probably going to be a little bit over 5 million. So the housing market are probably our best data going into 2020. But it's just one of these things that, do you really want to buy a house if you can't go into an open house?
What sort of effect, if any, actually, do you think that the government intervention will have or the fiscal response? Because as I'm asking that question, I'm thinking that people that are getting checks, that are receiving unemployment, I'm guessing that a lot of them are renters versus buyers.
You look at the upfront data, like 81 to 85% of the jobs lost were low-wage jobs. Those are future renters, people who rent homes right now. But you see the forbearance, right? So they go near 3 million loans are in forbearance now. So what that does is that any future foreclosures is going to be a 2021 story. Because you got between 3 to 12 months. Now, how many of these people actually would be foreclosed candidates? I can't tell you yet because there's this housing cycle has had the best loan profile we've ever had in U.S. history. A lot of people have good loans, good cash flow, nested equity. But if you're a 2018, 2019, and 2020 home buyer, and you bought the home with 3.5% down, you might be a future 2021 foreclosed candidate if you're part of this forbearance. But we're going to have to wait till then because right now, traditionally, you would just do the countdown to when the notice of default is going to be and then the next foreclosure. But all this is going to be delayed until 2021. And at that point, lockdown protocols most likely, hopefully, are gone. So you're just going to have that big, massive demographic patch going into buying with a little bit more supply out there. Because some of these people that can't own their homes anymore have enough equity to sell their house without going into a foreclosure or a short sale.
Okay, so I guess that answered the next question, which is what if this lasts longer than we currently think, and the economic malaise just drags longer and longer, and the forbearance just continues, and people are more and more people aren't able to make payments. Obviously, banks aren't able to take all their collateral back because if this is just across the board. So what happens? Do these mortgage payments get added to the end of the mortgage? Do banks take losses? Like what happens to the market?
Hopefully a year from now things are back to normal, because if you don't have the capacity to own your home, you should sell your house. Okay, that's the forbearance program. Some of these things are just 3 month deferred payments lumped into that fourth month. Some of these are going to be pushed out to the back of the loan. But if you are underwater or don't have enough equity to sell, you're a foreclosure. Everyone else, we're talking about trillions of dollars of nested equity. Nested equity is basically the equity you have above your mortgage balance. So some of these people are just going to say, you know what, I my job is not returned back. I'm going to have to sell my house. That would be a more fluid functioning way without getting, the banks tied into it. But there's going to be foreclosures for sure. And the problem right now is that when you do an open forbearance, the mortgage servicers basically have to make that payment to the bondholders. And now they're going, hey, listen, you told all these people they could just miss their payments. We don't have that kind of capital. So look for the FHFA and the government to provide some kind of facility pool to help that out. Because we had literally a mortgage meltdown, starting from March 9th all the way to 14th, where banks were getting margin calls, the early payoffs, all these loans were refinancing. So the business of doing home loans in America was just collapsing. It's because too many violent things were happening in the marketplace. So the forbearance is fine, but at some point, when the economy is going again, you're going to have to let some of these people go. You can't just say,
Are you worried about potential mortgage bonds missing their payments and this setting off some sort of chain reaction?
If the government doesn't facilitate some kind of service pool, then I think some servicers go out of business. There's just no way. And nobody has enough capital for a global pandemic virus. So your models are all broken. So right now, it's not as bad as some people think, but we'll see how long this lockdown. See, it's all about duration and scale with this virus. If it's 3, 4, 5 months that we're in lockdown, it's going to be a problem in the financial world. And you need to facilitate both ends to make it a plausible situation for both parties. But for right now, it's not as bad as some people thought. But again, if we go another 30 or 60 days with lockdowns, more and more people are going to take that forbearance. And you got to provide some facilities for the bondholders, for servicers, or else the system is just going to get more into kind of a tightening of a credit out there. And that's what we're seeing right now.
Okay, so that's where I was going with my next question. Are banks tightening their lending standards given what's going on in the economy? Are they still lending money?
They're lending money, but you got to be pretty clean. And I think it's a very prudent move. I mean, lending credit should get tighter in a recession. It should not get easier. So what you're seeing right now is what I call the high risk late cycle lending. Home buyers get basically pulled out of the market. We're talking FHA loans, very low FICO score, very low down payments. Those are where the credit is really getting tight, and it should get tight. One of the mistakes I thought we made as a country after the housing bubble crash is that we were giving too many FHA loans with down payment assistance, and that just created another wave of potential homeowners that were going to foreclose. So credit is getting tight where it should be tight, and I have no problem with that. Once the economy starts to kick in again, if the unemployment claims start to come down, the St. Louis Financial Stress Index comes down, then you'll start to see credit ease. But this looks perfectly normal to me, considering how bad this virus has impacted our economy. We should have tighter credit, but banks are lending. If you got a job, if you got a down payment, at 43% debt to income ratio, 660 and above FICO score, you can still get loans in this country.
What is the average down payment these days?
Average down payment nationally is about 10%. So it really depends. So you have some home buyers that have 20, 30% down easily. And then you have, traditional first-time home buyers that just don't have enough for even 3.5% down with closing costs. So it's kind of, you put those mix. Remember, sometimes as a country, we like to put renters into home buyers categories. Financials of renters are much different. And a lot of these people are in a barbell economy. They're just never going to make enough money to own homes. So you got to remember that home buyers, right now, especially in the last 7 or 8 years, are the people that are doing really well. So this is why the FICO scores are so high now, especially in the last 8 years of home buyers. It's the sub 620 or even sub 640 is a very small portion of the mortgage that we're taking this cycle. So it's a very clean economic cycle in terms of home owners.
What are some of the most interesting housing topics, specifically in terms of demographics? I saw you wrote something about how millennial housing demand is like through the roof, or at least was previously.
Yeah, I mean, for all this hype about the student loan debt crisis and millennials can't buy homes, 20-year high in millennial home buying. Purchase application, double-digit growth cycle highs. Affordability crisis is a great term for TV, but you can't have rising demand, stable inventory, and prices still going up if you have an affordability crisis. Affordability crisis is a deflationary event. So what you have right now, and this is something that I've been working on for 8 years, housing was always a year's 2020 to 2024 story. I mean, we literally had the weakest housing recovery ever recorded in history. And what I mean by the weakest recovery is new home sales and housing starts have had their weakest cycle ever. But now in years 2020 to 2024, you finally have this massive demographic patch, the biggest demographic housing patch ever recorded in history, about to get to their first-time home buyer age. So we're talking ages 26 to 32. The first-time home buyer median age is now 33. So that it gives you a great replacement demand. But on top of that, and this is what I think happened earlier this year, is that when interest rates start to fall, you get a little bit of more action on the first-time home owner moving up. You know, we build bigger and bigger homes for many decades. Housing tenure, which is the real story in housing in this cycle, is up to 10 years. So people don't need to move as much, but when you have that kid, that second kid, or you find a better job, you start moving. You add the first-time home buyer with the first-time homeowner moving up together. That's what you saw earlier this year. Looking at total home sales running about over 6.4 million. And home price growth was too hot early this year. 8% median sales price growth was too hot. If we didn't have this virus, I'd be talking about, no, home prices are getting too hot again. This is something we don't want to root for.
So the idea that millennials are just bogged down with student debt, are going to rent forever and never leave the city, you're not seeing that in the data.
Student loan debt is basically the left-wing version of what the gold bugs talk about. That's how crazy it is. It's just not. I mean, if you look at student loan debt, the majority of the debt is actually under 17,000, and majority of the loans that are actually default or delinquent are actually 10,000 and below. So the notion that, and this is the one thing that I always try to emphasize at conferences, people that finish school, right? They actually finish school, and then they have that debt gives them the capacity to own homes. Like my clients, a lot of these are college educated. They're making $200,000-$300,000 a year. Okay, they've got access to stock options. They have healthcare plans. These are not the struggling Americans that people like to make it out. That's why you see the education gap between those who finish college, who make the money, versus those who don't. So the notion that everyone had like 70 or 80 or 90,000 and that millennials could have, these are the upper income brackets of our country. These are not they're the struggling, what was the theme? The struggling millennials can't buy homes. No, it's 20-year high. We had the longest economic expansion in history, the longest job expansion in history. Millennials are at 20-year highs. Purchase application is growing. So the context of the discussion, because it's ideological, right? You know, if the government could, in theory, wipe out all student loan debt, it goes to the deficit. I understand that. But when you make it into this, oh, no, millennials can't buy homes. No, it was wrong, right?
So in wrapping up, I obviously don't have a crystal ball, but what's your take on where housing looks in the next 6 to 12 months?
As long as lockdown protocols are in, the housing market is in a coma. You just can't get enough transaction. What's different now compared to what the housing bubble crash was, is that inventory is falling because people are taking their listings off. Okay, so that's the difference. It's not like people are forcing themselves to sell or anything like that. People are just waiting back. You get people back on the out of lockdown protocols, housing will slowly get itself back up to where we were. Total home sales about 6 million. That's the things we should be going for. New home sales at existing homes back to 6 million. That's been the trend for the last few years. In time, it gets there. However, every month that goes by with lockdown protocols, you get more and more long-term damage in. So I think that's the equilibrium we're trying to find with the housing market, is how much damage is this virus going to do, and what's it going to look like, when lockdown protocols are up? Because the bonus is mortgage rates are low. Housing gets weak when the 10-year yield gets above 2.62%. Oddly enough, when we say this, 4.5% to 5% mortgage rates actually is problematic for the housing market. It isn't a crash theory, but that's where we see supply increase, demand fall down a little bit, especially in the new home sales sector. So as long as you could get people out there walking the earth again, okay, and then being able to do open houses and mortgage rates are low, housing will slowly get itself back after lockdown protocols. So I tell everybody, give it about 30 days after lockdown protocols are off, and then take a look at the housing market, because this data is just, it doesn't provide any value out here while we're still in lockdowns. We're going from the strongest point of the housing cycle to this comatose. We should be able to work ourselves back in, because the virus cannot kill the biggest demographic patch ever recorded in U.S. history for housing, and that's ages 26 to 32. That's still going to be here. Most of them are still going to be employed after we get off this. That's beneficial for housing. I think the damage we're going to see severely is in the rental market. That's where you should see the upfront damage, and maybe the long-term damage going out for a year or two is in the rental market.
All right, we're going to leave it there. Logan, thank you so much.
Pleasure to be here.